Welcome back to the deep dive. Today we're talking ETFs. You know those things that everyone's been buzzing about in the investing world. Think of it like ordering a pizza. Instead of, getting all the ingredients separately and making it yourself, you just get this pre-made pie ready to go. And from what I'm seeing in the research, it seems like ETFs are potentially a really smart way to invest. They offer this simple and low-cost way to diversify your portfolio so you're not putting all your eggs in one basket. Plus, you get to benefit from the market's growth without the headache of picking individual stocks, right?
You're absolutely right. ETFs are kind of unique in that way. You see, they function like mutual funds where you have a collection of assets all bundled together, but they're actually traded on an exchange, just like individual stocks. And this is what gives you so much flexibility because you can buy and sell them throughout the day.
Okay, that makes sense. But how do these ETFs actually track a specific index, like let's say the S&P 500?
Well, think of it this way. The S&P 500 is like a team of all-star players, right? So an ETF that tracks the S&P 500 is like owning a little piece of each player's success. You're basically getting a share of the entire team's performance.
Ah, I see. So you're not just betting on one player, you've got the whole team on your side. Okay, so that's how they work. But how do they actually make you money?
Well, there are two main ways. The first is what we call capital appreciation. This is when the ETF's value goes up over time. So let's say you buy an ETF share at $100 and then later you sell it for, say, $120. That $20 increase, that's your profit.
Pretty straightforward, right? What about the second way?
The second way is through dividends. Think of dividends as bonuses that companies give out to their shareholders.
Dividends. Ooh, I like the sound of bonuses.
Right, and some ETFs actually focus specifically on companies that pay dividends. So it's like getting a little extra reward just for holding on to those ETFs.
So it's like passive income.
Exactly, exactly.
Wow, I'm starting to see why everyone is so excited about these ETFs. What else makes them so great?
Well, one of the biggest advantages is diversification. Remember that pizza analogy we talked about earlier? It's like instead of just betting on one ingredient, you're getting a whole mix of flavors, and that's a good thing. Because with ETFs, you spread your risk across multiple assets, which can help minimize losses if one area doesn't perform well.
It's like they say, don't put all your eggs in one basket.
Exactly. And then there's the benefit of low fees. A lot of traditional investments can have these high fees that really eat into your returns. But ETFs are known for having really low expense ratios. This means more of your money stays invested and has the potential to grow over time.
So low fees, more money in my pocket. I like where this is going.
Precisely. And let's not forget about liquidity. ETFs are so easy to buy and sell throughout the day. It's like, you can walk into a store anytime you want compared to having to wait for specific trading
So
hours.
you're saying I have more control.
Exactly. You have much more flexibility.
Okay, got it. But what about transparency? How do I know what's actually in an ETF?
That's a great question. And transparency is actually another major advantage of ETFs. You can see exactly what assets are inside, so you know exactly where your money's going. It's like having a clear ingredient list on that pre-made pizza. No surprises. You know exactly what you're getting.
So I can be sure I'm not biting into any unexpected anchovies. Okay, I like it. But how do I actually get started with all of this? How do I actually start investing in ETFs?
Well, that's what we'll be diving into in the next part of our deep dive, so stay tuned.
All right, listeners, we'll be right back after a quick break. Okay, so I'm ready to jump into the world of ETFs. But how do I actually get started? Where do I even begin?
Well, the first step is to, open an account with a brokerage firm that offers ETF trading. Think of it like a marketplace where you can buy and sell these ETFs.
Okay, so where can I find these brokerage firms?
Well, a lot of them are online now, which makes it really convenient. Some popular ones that our sources mention are Vanguard, Fidelity, and Charles Schwab. They usually offer a wide variety of ETFs to choose from, and a lot of times, they have really low trading fees, sometimes even no fees at all.
Oh, that's great. So less fees means more money for me, right?
Exactly.
Okay, so once I've got my brokerage account all set up, can I just start picking out ETFs that look interesting?
Well, not so fast. It's really important to have a plan before you start investing. You got to think about your financial goals. What are you saving for? Retirement? A down payment on a house? Maybe that dream vacation you were talking about?
Oh, believe me, that vacation is definitely on my mind. So how do my goals, influence which ETFs I should pick?
Well, think of your goals as like a roadmap, right? They're going to guide you toward the right ETFs for your situation. For instance, if you're looking for long-term growth, you might consider an ETF that tracks, say, the S&P 500. That way, you're essentially investing in the entire stock market with just one purchase.
So if I want to grow my wealth slowly and steadily over time, the S&P 500 is a good option. What if I'm more interested in that passive income we were talking about earlier?
Ah, yes, the dividends. Well, if that's your goal, you might want to look into a dividend ETF. These ETFs specifically focus on companies that are known for, consistently paying out dividends to their shareholders. It's like getting a regular paycheck, but from your investments.
Ooh, okay, now you're speaking my language. So once I've figured out my goals, it's time to pick my ETFs, right?
Well, hold on there. Before you jump into anything, it's crucial to do your research. Remember, there are literally thousands of ETFs out there. Each one has its own, unique characteristics and investment strategy.
So, ugh, that sounds a little boring.
I know. It might not sound like the most exciting thing, but think of it like, like going on a treasure hunt. You're exploring this vast world of ETFs, searching for those hidden gems that really align with your goals and your risk tolerance.
Okay, I like that analogy. So what kind of things should I be looking for when I'm researching these ETFs?
Well, one of the most important things to consider is the expense ratio. That's the annual fee that you pay to the ETF provider. Remember, we talked about the importance of low fees. You want to find ETFs with expense ratios that won't, eat away at your potential returns.
Right, low fees, more money for me. Got it.
Yeah.
What else should I be looking into?
Well, you also want to look at the ETF's past performance. How has it done in different market conditions? Has it consistently grown over time? Or has it been, really up and down?
So I'm looking for ETFs that have a history of steady growth.
Exactly. You want something that's reliable.
Okay, but where do I even find this information?
Don't worry. Most brokerage platforms and financial websites have all sorts of tools and resources to help you with your research. They'll provide detailed information on each ETF, like its holdings, its performance history, the expense ratio, and, all those important metrics.
Phew, that's a relief. I thought I'd have to, like dig through mountains of financial reports to find all that. Speaking of information, our sources mention all these different categories of ETFs like stock ETFs, bond ETFs, commodity ETFs, and sector ETFs. Can you break those down for me a little bit?
Sure. So stock ETFs are pretty straightforward. They invest in, well, stocks. And they can track broad market indexes, like we talked about with the S&P 500, or they can focus on specific sectors like technology or healthcare.
So stock ETFs give me exposure to the stock market. What about bond ETFs? What are those all about?
Well, bond ETFs invest in bonds, and bonds are basically loans that you make to governments or corporations. They tend to be less risky than stocks, and they can provide a steady stream of income through interest payments.
So it's like lending money and getting paid interest.
Yeah, that's a good way to think about it.
Interesting. What about commodity ETFs?
Those are a little different. They track the prices of raw materials, things like gold, oil, or agricultural products. They can be a good way to, diversify your portfolio and potentially protect yourself against inflation.
Okay, makes sense. And lastly, what are these sector ETFs all about?
So sector ETFs focus on specific industries like, technology, healthcare, or energy. They allow you to really target your investments in areas that you think, have strong growth potential. For example, if you're really optimistic about the future of, say, renewable energy, you might consider a sector ETF that invests in solar and wind power companies.
Wow, there's so many options. I'm starting to feel a little overwhelmed here.
It's understandable. There's a lot to take in. The key is to just, take it one step at a time. Start by defining your goals and then research ETF that really align with those goals. And always remember diversification is key. Even though ETFs already offer some inherent diversification, it's still wise to, spread your risk even further by investing in different asset classes.
So I shouldn't just pick one ETF and put all my money there.
Exactly. You want to mix it up a bit. It's like building a balanced meal, right?
Right.
You wouldn't just eat pizza every day no matter how much you love it. You need a variety of food groups to stay healthy. And the same goes for your investment portfolio.
I like that analogy. So should I aim for, a mix of like U.S. stock ETFs, international stock ETFs, and maybe throw in some bond ETFs for good measure?
Yeah, that's a great starting point. A diversified portfolio helps to balance out the risk and can potentially lead to, better returns over time. But, it's important to remember that no investment is completely risk-free. And that's something we'll discuss in more detail in the next part of our deep dive.
So we've talked a lot about the good stuff with ETFs, like diversification and low fees. But you mentioned risks too. I have to admit, I'm a little nervous now.
Well, it's always smart to be aware of the risks involved with any investment. So let's take a look at some of the things to keep in mind with ETFs.
Okay, hit me with it. What should I be watching out for?
Well, one of the inherent risks with any investment really is market volatility. The value of your ETFs can fluctuate, just like the overall stock market. Things like economic news, global events, even how well individual companies are doing can cause those ups and downs.
So even if I've got a diversified ETF, I could still see my investment value drop.
Yeah, it's definitely possible. But it's important to remember that volatility goes both ways. While downturns are inevitable, the market has historically shown a tendency to recover and grow over the long term.
So it's about having a long-term perspective and riding out those waves, right?
Exactly. Investing is a marathon, not a sprint. Another thing to remember is that most ETFs are passively managed, meaning they track a specific index and aim to mirror its performance.
Okay, that makes sense. But what's the downside of that?
Well, the good thing about passive management is that it usually keeps costs low, but the trade-off is that your ETF's performance is directly tied to the index it's following. So if that index underperforms, your ETF will too. You're essentially along for the ride wherever the market takes you.
So there's no like superstar manager making adjustments and trying to, beat the market.
Right, that's the main difference. Now, there are actively managed ETFs where a fund manager does make those buy and sell decisions to try and outperform a specific index.
Oh, interesting. So could actively managed ETFs potentially lead to higher returns then?
Potentially, yes, but they also typically come with higher fees because you're paying for that expertise of the fund manager. And those fees can eat into your returns, so it's a trade-off to consider.
So higher potential returns, but also potentially higher fees. It's a lot to think about.
It is. And it's really important to consider your own investment goals, your risk tolerance, and, really understand how those fees can impact your returns over time.
Wow, this whole deep dive has been a real eye-opener. ETFs seem like a fantastic tool for investing, but I'm also realizing they're not, a guaranteed get-rich-quick scheme. There's definitely a lot to consider.
You got it. They offer an accessible and potentially very rewarding way to invest. But like anything else, there are risks involved.
So if you could give one piece of advice to someone just starting out with ETFs, what would it be?
I'd say remember that investing is a personal journey. Define your goals, do your research, and really understand both the benefits and the risks involved. And never forget, knowledge is your most valuable asset when it comes to investing.
Well said. It's been a pleasure having you on the show and learning from you today. And all our listeners out there, we hope this deep dive has given you the knowledge and the tools you need to make smart decisions about ETFs. Happy investing, everyone.